So I'm Jake. I lead up a big portion of our research and innovation function here at EIP, focused on the built environment.
There's deregulated markets, there's regulated markets. They might decide at some point, hey, we want to sell the energy back.
We're talking about two mega trends colliding in an industry that hasn't seen a lot of innovation for a few decades. We are in a different world than 20 years ago, where growth had flatlined for a while and folks needed to look for new growth opportunities. Model developers have a bit of a leg up if they can get there first and build some scale. Those buildings that either have not seen this focus on cloud layer on top and or just like don't have an automation system in the first place. You can add value out of the gates without having to compete against those big players.
Hi, everyone. A little special episode today. Lewis actually can't make today. He's in transit, but I'm going to run through a great discussion with Jake Elder, who I've known for a number of years, works at Energy Impact Partners on the research team, and we have a lot to talk about. Some of this was in a newsletter issue from a few months back, well, later in 2024. He's done a lot of research on just technology in the built environment, and we'll get into all of that. But first, Jake, can you give us a little introduction to yourself and then also Energy Impact Partners for those who don't know the venture fund?
Yeah, absolutely. And thanks for having me on. We're sorry to miss Lewis today, but Joe, you and I have been talking about this topic and even having this conversation for probably a year at this point. So really looking forward to digging in and unpacking it. Maybe just a little bit of background. So I'm Jake. I lead up a big portion of our research and innovation function here at EIP, focused on the built environment. Energy Impact Partners, for those that don't know, is about a $4.5 billion assets under management venture and growth investment platform that's fully focused on the energy transition. What makes us a bit unique is that we're backed by a coalition of strategic partners, including a number of electric utilities that are really looking to understand and position themselves for the energy transition in a really strategic way. And over the years, we've diversified that coalition beyond just electric utilities to a host of industrials, including a number of commercial real estate owners and operators. And we work really closely with that strategic coalition on thesis development, on market research, on our diligence processes, and then on commercialization and growth, helping our portfolio companies identify opportunities to work with that coalition of partners. Within that ecosystem, our research and innovation team really serves as that flywheel, working with our limited partner base, working with our in-house investment teams, and then working with our portfolio of about 120 plus companies, and really trying to make music out of all the noise and chaos that's spinning out of that ecosystem. So we work really closely with that group of experts in the business at big electric utilities, big real estate operators. We work really closely at the same time with that portfolio of startups and entrepreneurs and try to help them really meet in the middle and drive innovation.
Yeah, my sense is any asset class is interesting to EIP. When we think of real estate, we oftentimes think of from a home up to a very, very high-end commercial office space. And then in between, you have things like hospitals, airports, data centers now are obviously relevant. You're really looking across that entire array of asset classes.
Correct. Across the entire array of asset classes, and also looking at this from both an electric utilities point of view as well as from a consumer. The good news is that there's lots of opportunity when those two sides of the table sit down together and look for opportunities to collaborate, right? So in many ways, we get to have a real 360-degree picture of what's happening around energy from both the supply side and the demand side. But in terms of the commercial real estate space, that's right. We've got, partners of ours that are big data center operators that, own and operate and develop office complexes. We've got a few multifamily partners, self-storage, et cetera. So see a really diverse set of needs. And
yeah, you make a good point. It's funny, when I've in the past done work with utilities here and there, the way they think about the asset classes, I would generally summarize it as they seem to group things as there are homes, right? Like every home is a very small amount of load on the grid, right? So an individual home doesn't really matter. A whole fleet of homes or a whole portfolio of homes, that does matter. And that's where smart thermostats come in. And then there's the really big buildings where they can move the needle. You would say the industrial facilities move the needle more than just a large office building. Then in the middle, there's just a lot of small commercial spaces that, it's the local coffee shop, the local restaurant. And that oftentimes is the most difficult part for them. But, from a real estate perspective, there's a lot of asset classes within each of those groups.
Yes, absolutely. And maybe the one nuance I would add for anybody that's been following the mainstream news these days, certainly data centers have become maybe not most important, but most interesting customer of the moment, right? Given the size of those new projects, in some cases might be as large as the entire rest of the customer base in a certain, small utility territory, for example. And, they want power quickly. So the industry is really wrestling in real time with how do we meet those needs? How do we do so without, having to spend a bunch of money that gets, recovered on the back of, a bunch of residential customers? And how do we do so quickly to maintain our, increasing potential arms race with a bunch of other, actors when it comes to AI model development?
Absolutely. It's funny. There's that graphic. I think I saw it last week where maybe it was from a Meta earnings report, but they showed a picture of Manhattan and they said, we're building a data center that's like the size of Central Park, maybe even bigger. And just visually, the energy use, I would argue, per square foot is probably higher in a data center than most places, maybe not in downtown Manhattan, but it's comparable. And so, yeah,
Probably anywhere
they
else.
are an interesting place. Yeah. Well, great. So when I think of venture funds and I think of, the research function within an investor that's been investing across many years, you often get to investment theses and like, what is your investment thesis? And one of the things we've talked a fair bit about is what you're calling the electrical utility gauntlet. I'd love for you to unpack that and just tell us a little bit more about that, because it's really interesting. I think it's a really good way to think about what's happening. And I'm sure that we'll have plenty to talk about.
Yeah, happy to unpack it a little bit. But first of all, maybe a hat tip to EIP's head of research and partner, Andy Lubershane, who's coined that term and really, I think, helped us flesh out a lot of the macro vision here. But really, when we talk about the electric utility gauntlet, we're talking about two mega trends colliding in an industry that hasn't seen a lot of innovation for a few decades. So the first of those trends, of course, is the desire to decarbonize the existing electric grid. Historically, that's been a lot of coal plant retirements. It's been the deployment of some new gas, but also a bunch of other infrastructure investments to move all the low-cost wind and solar from pockets in the Midwest, for example, out to the coastal communities where we actually consume electrons. Right? That's a once in a generation challenge. It requires turning over much of the capital base for many of these big electric utilities, and is really difficult. At the same time, because of our decarbonization on the customer side, as well as because of these data center projects and some other investments we've made to onshore manufacturing, our utilities are having to grow their infrastructure overall, regardless of the decarbonization progress they make. And depending on the estimates, depending on who you talk to, in 25 years, we're going to need about 2.5 to 3x the overall number of electrons that we need today, whether that's from new data centers, new manufacturing, or actually more so the electrification of industry, the electrification of our buildings, electrification of vehicles, et cetera. And making that even more challenging, if you look at it on a kind of, seasonal basis, for example, during those few hours a year when the grid gets really constrained, the peak demand might increase by 5 or 6x, right? Like on a really cold day when everybody's electric heating systems are cranking on, when everybody's EVs are not getting the same efficiency, so they're needing to charge more frequently. The amount of power that these utilities are going to have to deliver is going to be, materially more than it has been in the past. And this is an industry that, let's remember, for the last 20 years or so has more or less been flat, right? It's not an industry that has been experiencing hypergrowth by any means. And so in many ways, it's starting to rebuild those muscles, but it's not like it's an industry that's been growing 10% year over year for 2 decades and really has the kind of growth skills in-house to capture it. And so as a result of that, here at EIP, we feel like certainly for the next 5 years, but perhaps even beyond that, we're generally going to be short electrons, period. Much less carbon-free electrons or clean electrons that we know a lot of our ambitious corporate decarbonization actors are looking to secure, right? And so for utilities with a fundamental regulatory obligation to provide customers with reliable power and to try to keep those costs affordable for everybody from the data center to residential single-family homeowner or owner or renter, it creates a really interesting set of both incentives and opportunities as well as challenges. And from where we sit at EIP, right, working really closely with many of those utilities as well as their customers, we're starting to see a number of those leading utilities really lean in and think differently about their fundamental relationship with their customers from the start. They're starting to be more collaborative. They're starting to think about how they can send better price signals and really how they can encourage the adoption of grid-friendly systems as opposed to systems that might make more sense just for the customer alone, but aren't necessarily as beneficial to the grid. To say that another way, I've used this comparison in the past. The kind of utility sector at the moment has 2 paths it can choose to go down. It can choose to, continue business as usual and let its customers take its action as it wants to. And those customers will probably accelerate decarbonization in some areas and maybe not in others, but they're going to act independently, right? They're not necessarily going to act in the best interest of the grid. Or, and I think this is the direction we are likely to go down, utilities are likely to lean in, start to send some more signals to their customers to say, hey, if you do X rather than Y, we'll help make the economics pencil for you. And if that happens, the overall cost of this transition is a lot cheaper. Maybe just to pull it all together with a couple of takeaways for real estate, and then I'll pause and let you jump in. Maybe four big messages. The first is that it's going to take some time for the utility sector to catch up here, right? This is a 20 to 30 year infrastructure game. This is not a 3-year, turnaround project. But at the same time, moving through this energy transition and getting to a, carbon-free power system at the end of the day without the grid and without these utility actors is a little bit of a fantasy, I think. Certainly there's some good studies and some good analysis to suggest that for certain types of projects, off-grid, solar plus storage plus some gas generation might be low cost in the short term, but the grid is really one of the marvels of 21st century society, and we definitely want to keep it around for lots of reasons. The second would be that we do think that in many cases the price of electricity is going to get more time variant, right? During those hours in the day or in the year when the system's really constrained, right? The incentives and the signals are going to start to, get more material and probably ultimately just more expensive, right? If you think about the underlying utility compact, the deal is that, utilities, when they can justify that certain investments are cost effective, as approved by their regulators, they get to earn a return on the, equity invested there. And we're entering an era of really high capex for the sector, and therefore, that's likely to lead to higher rates at the end of the day. And so really close collaboration between utilities and their customers is going to be really important to keep those electrification plans on time and on budget. The third piece would be like, as you're probably seeing me start to hint, right? The moment for not just energy efficiency, but for grid interactive buildings and grid flexibility is coming, if not is here. And so we see things like distributed generation and storage technologies becoming increasingly prized by grid operators, and in some cases even seeing utilities lean in to try to incentivize or even deploy energy storage assets on customer sites on their own dime. And then lastly, electrification certainly is the leading pathway to decarbonization, but it's not the only pathway. And so we certainly see places where much higher efficiency paired with lower carbon fuels, for example, might be a better approach for the share of a building's energy needs, especially in a building that's going to be really costly to retrofit. You don't necessarily need to fully electrify everything to decarbonize at the same time.
Yeah. Fascinating. I was just writing a couple things down because I didn't want to forget a couple follow-up questions. The point on the grid, you've probably read it, but there's a great book called The Grid. I think the author was Gretchen Bakke, probably pronouncing her name incorrect, Bakke. Really just fascinating. Some of the stories she's telling about how the electrons move from, I think the one example in the beginning of the book was the dams in the Columbia River Gorge, where there's a lot of hydro, and that's why Washington has really cheap energy, and then down to California, where you have a lot of demand. So a great book. When you're looking maybe from an LP base, from just like the electrical utility gauntlet, one of the things a lot of people, when you dig into how do electrical utilities operate, there's deregulated markets, there's regulated markets, and in some cases there are firms that really just focus on the distribution. There's others that focus on generation, to be kind of high level and simple about it. Do you see differences in how they're approaching the gauntlet, if you will, in that your point of the grid being essential? I think that's especially true for distribution, right? Because even if in the future, an owner of real estate, right, you're seeing data centers say, well, we're going to buy a utility power plant, or we're going to buy a nuclear power plant. And obviously a lot to do administratively, regulatorily to get there. But you can say they might decide at some point, hey, we want to sell the energy back at certain times because we know we don't need it. And that's penciling this. Well, you need a grid to do that. So I'm just kind of curious, those who own the power lines and those who own the power plants, they're not always the same.
Correct. And really we've delegated, a lot of the authority here, right, to states and regions to, craft energy policy here in the United States, at least. And so you have a wide patchwork of those models, right? And I think those who are maybe more anti, the utility sector and more towards some future with, blockchain empowered peer-to-peer energy trading for everything probably missed that point, right? That like, even if you wanted to split out those that generate power from those that distribute power, or even those that distribute power or transmit power along long distances versus those that, distribute it into an individual building, that distribution level grid really needs to be there kind of no matter what, right? In order to provide some resiliency, even if you had a bunch of on-site power in one facility, right? That facility probably wants to have some redundancy, and the cost to just have their own redundancy versus having a distribution level redundancy is obviously much greater. So I do think that the incentives vary, and for those that are like a fully integrated, vertically integrated utility, as we would say in the business, that control everything from the power plants to the poles and wires to the relationships with the customers, they maybe have the most opportunity to lean in because they own every aspect of the value chain. They're having to invest on the capital side in new generation that they might not need to build if they can find another way to unlock that capacity at the grid edge. And those, but even those in the poles and wires of the transmission and distribution piece of the industry alone also can see a lot of value in this, and especially because there can be a lot of reliability benefits at the edge from having a bunch of customers that are networked together, that are deploying batteries, et cetera, right? You can create what one of our founders and CEOs calls fractal reliability at the grid edge, where you've got enough redundancy and assets and they're all connected together, where it doesn't matter if the broader power system goes down, it doesn't matter if your battery in your building goes down, because you're networked with everything else at the end of the line, so to speak, and you can kind of pull power from another site. So I do think there are value propositions for all of the different types of players in that space. How you monetize it and how you take advantage of it might vary. The other model, for example, we're tracking a couple of startups in Texas that are retail businesses. So they're focused on residential energy sales at the end of the day. They don't touch the generation, they don't touch the poles and wires, they just do the marketing. And there's a few of them that have started to either offer subsidized or free batteries to all of their customers at the end of the day. And it sounds really nice. What they're really doing is they're getting free energy arbitrage, right? Because they've agreed to a certain rate overall with that customer, and then they can charge the battery when the incentives suggest and the market prices suggest that they should charge it. They can discharge it to the customer during those hours when electrons are really expensive. And there's enough of a spread in Texas that at least a couple of these folks have been able to raise tens, if not hundreds of millions of dollars to go after these markets. So the economics are clearly at a point where they're pretty positive on those kinds of investments.
Yeah. And Texas is probably the best example. I know years ago, I used to live in Illinois, also a deregulated market, and we would just get all kinds of mailers from energy suppliers that just said, switch to us and you'll get a free, and I don't know if there were ever like free iPhone, but there was definitely like a free Alexa, a free smart speaker. They always had in big letter, like, you'll still get your bill from ComEd. Was in Texas maybe around that same time. I remember just billboards everywhere. And the churn there, I think one of the things a lot of people don't necessarily know is the churn of customers typically is very high. So maybe you could argue if we put your battery in your home, there's less churn because just the cost, the CAC there must be really high.
Yeah, that's a good thought. I hadn't thought about that angle, but I would assume you're right? As soon as you've got a physical asset in there, and as soon as like it's powered you through one brief power outage, your customer loyalty probably goes through the roof.
Even the affinity, if they just put their logo on top of, if it's a Tesla Powerwall, it's like, we're just going to cover that up and act like it's not. Yeah, it's interesting. The other thing you were touching on when you went through a couple of the kind of key takeaways is the role of the utility changing. And it reminds me, utilities have been, and maybe I'm just interested in your perspective here as it relates to what's moving, where we're going in the future. But utilities, I mean, the business model, yes, they're a regulated entity, but they have the right to get a return on their investments, or return ROE, as you said. But they at the end of the day sell a commodity, though they're somewhat protected, right? But there have been a lot of attempts over the years at changing the business model. I'm thinking back to, I think it was Duke Energy, even like 10 years ago, they might have bought a home security business. And I think the idea there was, well, this is more customer affinity. They owned for a while was still operating pretty successful energy management company. I think it was Phoenix Energy Technologies. They're still out there, but they were owned in some way or partially owned by Duke, which again is just typical cloud-based energy management software. I'm sure there's many more examples, right? I'm just thinking of a couple. Yeah. Obviously, those utilities are investing in EIP, and you're investing in all kinds of companies across the utility territory. But do you see there being, within this concept of the electrical utility gauntlet, that the way they're thinking about doing more than just selling the electrons, is that changing much? Or
good question. So maybe a couple of things just foundationally. First of all, so most of these are big conglomerates at the end of the day, right? And so Duke Energy, Southern Company, they own multiple operating companies that are regulated utilities, and then they often have what you might hear called a non-regulated business that operates and tries to monetize other business activities that are not subject to utility commission regulation and not core to your business, as you noted. And so the types of programs that you've talked about, where our utility partners do make commitments to EIP, those are all happening in that non-regulated world, and they're shareholder dollars. They are not what we would call ratepayer dollars. They're not customer dollars at the end of the day. They're going to those programs, and they take great care, and EIP takes great care not to cross those lines, because they're two fundamentally different pockets of money, and they're subject to different constraints, and we need to make sure that we're covering the law and being careful there. That said, I'd say in some ways we're seeing some additional lean into some of those new ancillary areas. However, we are in a different world than 20 years ago, where growth had flatlined for a while and folks needed to look for new growth opportunities. Right, this industry today is, most of our C-suite folks that we spend time talking to will remind us, is not short CapEx opportunities. And so in many ways, that's actually why a lot of this kind of customer partnership stuff starts to make a lot more sense and become a lot more interesting. In a world where you have a fixed amount of CapEx projects that you can deploy and make a return against, right, you start to be more careful with which projects you execute, and you want to make sure you pick the best of the best, and that's it. In a world where you've got way more capital deployment opportunities than you can possibly raise debt to go execute against, you start to see more value in having others, maybe wear some of that cost alongside you. And so I think we're in a moment where customer sited or customer supported batteries, virtual power plants, et cetera, start to become more interesting. A, because we can provide some frameworks for them to return that ROE themselves and make a strong return on it. But B, because it has a whole other two other sets of value actually that matter more in today's era. The first of which is that resiliency value prop that we kind of already talked about, right? Increasingly important in an era of extreme weather events in particular. But the second is that the more they can shift consumption around in time, the more customers they can connect to the grid overall, right? So intuitively, I think all of us know this, but if you step back for a second, any given real estate building has a very different energy consumption profile. And when you stack all those consumption profiles together across the utility service territory, you get what we call a load curve, right? What does the demand look like on any given day? And when you run that over the course of a year, you get a really extensive load duration curve that basically tells you of all the customer demand you could possibly get, how many hours a year are you at your max capacity, and how does that kind of shift over time? And the details vary by market, but the reality is that most of our utilities in the U.S. today are seeing shortfalls or seeing potential shortfalls coming in the next few years only for maybe 50, 100, 200 hours, right? And so if they can find a way to shift some customer demand off of those 50, 100, 200 hours to another time in the day, they can then theoretically interconnect a whole new customer, provide power to a whole new data center, et cetera, without building a whole lot more on their side. And that has a bunch of benefits. It lets them attract the customer in the first place, which brings a lot of economic development value to the utility. It also lets them spread the rest of their cost base out across that new customer as well, which theoretically takes a bunch of rate pressure off of everybody else. And it helps them really just kind of attract, especially these data center customers that are really focused on speed to power. And so in many ways, it's that last value proposition that has folks thinking differently about how they engage with their customers, because marginal shifts in, when somebody consumes electrons can have a meaningful shift in the overall grid's ability to service more for the same installed cost.
Yeah, and those 50 to 100 hours, you could argue a couple hours a day over if you're in a very hot area, the summertime, right? July, August. Sometimes in like Northeast, you could argue there might be some peak days in the winter, but utilities probably know about when those days will be, and being able to kind of modify behavior in those days, to your point, is highly impactful. And you think of how many hours there are across a year. I mean, thousands of, I think 8,000 some hours, not a lot of hours that you really need to affect to do all the things you're talking about.
Yeah, exactly. Yeah. 87, 60 hours, right? And if you're talking 200, 300 hours a year, it's a very small amount. Over time, right? Once you've moved those 300 hours, you've then got a 500 hour a year problem or a 1,000 hour a year problem. And eventually you lose all the spikiness in the curve and it just becomes a block. But we've got a long way to go until we get there.
Yeah. Maybe that's a good kind of segue into the other topic to discuss. You had reached out to me. You were working on a report. We put a couple of images in a newsletter, and we'll link to that in the podcast, but a couple of images or pieces of analysis. And we did a Q&A, a written Q&A in the newsletter, but that was kind of looking at the future of building automation systems, the future of in-building technology. Obviously, that relates a lot to everything we're talking about, because the ability to affect changes in demand in a building at scale is how you get the grid flexibility that the utilities need. Maybe to start, give us, just for those listening, a little bit of a background on the report, and then we can talk about some specific findings, at least, of the report.
Yeah, happy to share a bit. I mean, at the top level, we kind of bit off kind of building energy management and smart buildings as a category that we wanted to spend some meaningful time on probably about a year ago, and spend about 3 months really going heads down, talking to 40 or 50 novel technology companies, talking to all of EIP's partners on the demand side, right, who are actually consuming or looking to procure these types of technologies, and talking to a bunch of other industry experts, and then ultimately bringing a bunch of folks together in person for a few days to kind of workshop some of our theses and evaluate some potential investment opportunities. We picked the space as one to go deep on, not because it was totally novel, right? You spent your whole career in this space, and it's obviously one that at EIP we've been tracking for a while. We see many of our real estate partners deploying various pilots. We've got an investment in Measurable, which has a product in that space, although it's not necessarily their core product, right? And yet we've never really seen anybody crack the code or break out from a entrepreneurial perspective solely on the back of a building intelligence product, right? There've been some successful businesses built, but not on that alone. And so that's why we haven't made an additional investment in that space directly. But given the rise of AI, the rise of a lot of really low cost next generation computing, we kind of thought like it was the time to take a fresh look and see if things had changed and why they'd changed, and also try to get a sense for how the utilities may or may not be leaning in to encourage or incentivize or support some of these next generation capabilities.
Yeah. It's interesting because to your point, I think we can both agree you still have a lot of fragmentation, right? The control systems, the legacy control systems, the HVAC equipment, those are the big OEMs. There's not a lot of fragmentation there, right? If you need a chiller, there's only a handful of companies you're really going to call. I guess maybe there's a larger number if it's kind of more for a custom use, but in a building, in a hospital, you're calling one of, I don't know, 4 or 5 companies, most likely. Maybe you can sub them out for heat pumps, but maybe not. If the building's already built, the infrastructure required to do that. So you don't have a lot of fragmentation there. The service providers and just the value chain of how does said piece of equipment get into the building and how is it maintained, that's a little bit more fragmented. And then I think there's also a lot of fragmentation when you get to the cloud-based analytics players. And I think that's led, be interested in your feedback on this, but that's led to a lot of companies that are in market that have clients that are making money, but are not necessarily growing a whole lot. And I think that what they would probably tell you is, well, we're competing, but we're not competing against 2 or 3 peers. We're competing against 20 or 30 peers. And the dynamics of the market just across all different stakeholders are very different. And I don't think that's changed a lot. There's definitely been some M&A. I mean, I cover the M&A, but it's not like that's actually consolidating the market, if you will. And I think you kind of looked at some of this. Yeah.
Yeah, I've got a lot of respect for all of the entrepreneurs that are working on this challenge, right? So there's no knock here, but in many ways, I asked every single person I talked to, I was like, "How are you different?" And I don't just want to hear you've got a percent energy savings that is compelling, but I want to really know is unique about you versus, to your point, your 30 other competitors. And I got a lot of nods and acknowledgement of the problem, but I didn't get a single really compelling answer in terms of how one provider was really materially better positioned than the rest of the market to capture the opportunity. And so, I think we remain very bullish on the opportunity set here, given a lot of the context that we talked about. But and we can certainly share some ideas on some of the theses for ways to break out. But I think I was a little bit disappointed that we didn't find the answer in the work, and that most folks, are stuck on the legacy automation system providers are a bit stale. Their user interfaces aren't great, and we've got a flashy interface, and we can deliver really powerful savings, right? There's a lot of those conversations and nuances here or there. I certainly learned some interesting things along the way, but nobody that really had a fundamentally kind of different theory of change in the space.
Yeah, and I would argue, or I would think, there are areas where companies try to differentiate, and I think there is some differentiation, but it's not company to company as much as it's cohort to cohort, right? There are definitely companies that do a better job of deploying quickly, right? It's not going to take us 3 months to roll out. It might take 1 month, and there's different ways you can do that when you actually look at tactically how do they roll out fast. Sometimes in certain buildings, a day to a week, that's all viable, but it's not one company that's kind of unlocked that. It's a subset of companies. Some companies focus on how do they go to market. Is it direct? Is it a channel? Is it both? Is it to an OEM and partner with them? But again, it's not one company that's figured out, oh, well, we can go sell to the OEM and they'll white label our product, right? There's a few that do it, a few that don't. You probably have others there too, where you can say, well, you think you're unique and maybe you're unique against 1 or 2 peers, but there's other companies that are doing about what you're doing. And then the interface piece, I mean, a lot of that is just, as a former product manager at JCI and other places, the challenge there is every user is going to have their own preference of what does it look like. And that might inform how you have built your interface, your UI, which is fine. It might be very intuitive, but there's going to be a whole handful of other people who say, oh, I want it a different way. And still having those discussions is challenging, right? When you're operating a company and it's hard to figure out, well, which way do we go?
Yeah, I mean, I guess maybe my question back to you on that would be there's certainly a view here that this market is really important. There's lots of demand for it, but there isn't that much space for differentiation technically, period, right? The models aren't that complicated relative to all the other potential, models to be developed in the world and problems to be solved, right? And so I just wonder if inherently there isn't space for differentiation because, identifying faults in a building and, taking action against them, there's only so many things you can identify and only so many, actions you can take.
You make a good point. I mean, my quick response is I think there are some places where there might be a little bit of differentiation. I think when it comes to grid flexibility and being able to take signals from the grid, you're seeing that much less. You could argue maybe on HVAC optimization where you're actually controlling the building in real time or controlling significant parts or significant elements of demand or energy demand and energy consumption in the building in real time. There's a little bit of differentiation there. But I think this idea, I mean, the first step and where a lot of companies where they say, we've saved 10% energy savings is kind of a good number. There's obviously examples where companies can save more. There's some companies where, we're very simple. We don't save that much, but the ROI is still great. there's a lot of similarity in how they would go about doing that. And there's also going to be operators of the buildings who might say, oh, well, I can figure that out myself as long as I get an individual to go do it. And their response, you could say, well, but we have software that does instead of a person. You might still need the person to go and make changes physically in the building to actually realize those savings. So identifying the savings is one thing. Realizing the savings, you could argue, is a separate action or activity. You shouldn't think one is the same as the other.
Yeah, I buy that. I mean, I've seen enough pitches to save 7 to 13% energy through optimization to fill a long book. So I definitely have heard that pitch before.
Yeah, that makes sense. Well, you had said, Jake, a couple of ideas from the research of ways startups and innovators can break out or can differentiate. Maybe just give us a couple examples of those, and we can just talk about them a little bit.
Yeah, happy to. So, I mean, I think a couple of angles here. Overall, I think maybe the most useful thing is to really think about some of those use cases that are differentiated, right, and that are like you mentioned, demand response or grid flexibility is a really good one, where there aren't that many providers that have built those capabilities today. It's an optimization problem, but it's complicated because there might be multiple incentives from different partners, and you really need to understand a lot about power markets and build those workflows in and communicate with your customers. You also need to know what you can actually flex and what you can't, which is a separate topic, right? About how do you really drive that kind of optimization in a commercial building where energy isn't the ultimate driver of value. It's productivity. So, really, I think that demand response piece, and perhaps there's a couple of other, outsized new use cases. I'm anxiously kind of watching the true autonomous control space to see whether anybody can build credibility in that space and actually get, meaningful building operations buy-in for, letting the robots fully take over their systems as opposed to just
still a lot of skepticism on the part of operators.
And I understand it, but also the AI developments that we're seeing are coming at a remarkably fast pace, right? And soon enough it will be a safe option, right? That's not going to screw up, and it'll make better decisions than any human could. So I think that's coming, and that's a piece where I could see model developers have a bit of a leg up if they can get there first and build some scale. And then maybe the last piece is certainly to think about underserved building types. So cold storage is one, multifamily is another, the data center industry is perhaps a third, right? But those buildings that either have not seen this focus on kind of the cloud layer on top to date, and or just don't have an automation system in the first place, right? And so you can add value out of the gates without having to compete against those big players.
Yeah, I mean, one of the takeaways I think from just talking to you about the report, I didn't read the full report. You I think gave me some sneaks. We put some of that in the newsletter, but you had one takeaway was it's hard to rip and replace the building automation system. I would think it didn't explicitly say this, but the cooling system, the HVAC system, the heating, that's probably in the same bucket of it's unlikely somebody rips it and replaces it unless you're end of life. But that's every few decades versus every few years. So the conclusion there was really, if you're trying to play in this space, you shouldn't think about replacing. You should think about supplementing, sitting on top. Though that's very different if the building is a simple building and doesn't have a building automation system, right? If it's a rooftop unit and a thermostat, you might actually rip out your thermostat and replace it for something much better.
Absolutely. I mean, that was one of the bigger insights from the start, right? Both, realizing overall that BAS systems are, widely deployed today, right? Not just in the mega buildings, but most buildings over 50,000 square feet have some kind of automation. And these are critical tools for building operators. And so, the reality that you're going to convince them to rip out their whole operating system just to get better energy management, tools is probably just not realistic. I mean, I would be interested if anybody happens to have done that. Please reach out to us and tell us, because it would be just interesting to see whether anybody's actually ripped an automation system out just to do better energy management.
I've anecdotally heard some stories, and we can catch up offline, of companies that don't rip out the building automation system. I mean, one dynamic, you might have a portfolio where there's 3 or 4 building automation systems across the board. So they already aren't sure, well, where do I go to operate my facilities? Because really I'm going to 3 or 4 different places with 3 or 4 different interfaces. But I've definitely heard from some companies who say the first step in the operator, in the actual engineering room where they're monitoring everything from elevators to life safety systems and fire life safety systems to building automation and HVAC, they say, well, the first place they go is our analytical platform. They don't replace the building automation system, but it's at least a way to prioritize and figure out where are my big problems, because alarms going off in one building automation system versus another, you just kind of mentally have to know, well, that's more important than that. But there could be ways that actually you pull it all together and say, okay, this is actually the most important thing. But again, it's very anecdotal to your point. It's not like there's a shift in the market where everyone is saying, I don't need my building automation system. And you talk to some portfolios and maybe they've gotten everything to one centralized building automation system or two centralized building automation systems. And they find that it is manageable.
Maybe though, right? Like I think most folks might not realize this, but I would guess that almost every large portfolio owner or operator out there has everybody, right? Like, and has a meaningful share of 4 to 5 different vendors in their mix, right? And they're doing that for a few different reasons, but part of it's just the commercial real estate business model, right? You might buy a building that's got a certain system in it, and it's not going to make economic sense to rip it out, right? Even if you have let's use that 7 to 13% range. Let's say you have a low performing system that's getting 7% energy savings. That's half of the overall value proposition of a top performing system, right? And so you probably haircut all of the savings you actually need to justify the cost because you've already got something in place. And then, don't forget that owner might be planning to sell the building in 3 years. And so, rationalizing onto an enterprise platform doesn't make any sense, even if it might have paid off in 5 years, because they're just going to flip it in the short term. And so I do think, to your point, that, you have to move above that layer, right? If you want to really think about driving any kind of enterprise strategy. And if you're just trying to sell folks on, we can build a better widget to, just provide some high level insight and analytics, you're going to have a really hard time convincing anybody to move, even if your argument's true.
Yeah. And just doing like the simple math as we're talking, a building automation system, I tend to think price $150 to $7 per square foot. Those are usually one-time costs, right? But that includes the hardware, that includes the software, which usually comes along with the hardware, includes the install labor. Energy in buildings, typically, the 3 to 30 to 300 from JLL back, 8-9 years ago now, $3 per square foot energy cost for a building. So even if you're saving 20%, that's 60 cents. And maybe it's a higher end building. So you are at that upper end of that $7 per square foot. It's going to be really hard to make that math work and say, well, all of our other buildings have this vendor's products. We want to move this building. And then in terms of the acquisition and disposition frame, way things work in commercial real estate, at least, they're typically not spending a huge amount of time saying, they're figuring out like what actually needs to be replaced, what actually needs to go in the capital plan. And already they're not looking for new things to spend money on, right? So the idea of switching over to a building automation system just to make operationally it a little more efficient, to your point, I don't think that's going to be on the radar or on the roadmap.
Yeah, the reality is, look, like commercial buildings just aren't that into energy, right? To your point, it's a very small portion of the overall operating expense. And there are other value drivers that matter associated with energy, like O&M, uptime, resiliency, et cetera. But trying to sell a solution just on the energy value alone is tough given all those things.
Quick follow-up. You noted other asset classes, right? Like you look at CBEX, which is the Commercial Building Energy Consumption Survey, really the best resource, I would argue, from the Department of Energy of just how many buildings are there? How many square feet are there? What kinds of equipment is in those buildings? If you really dig into the data, there's a lot to learn, but you do have bigger asset classes, smaller asset classes. Offices are big. I think there's actually more industrial warehouse space than office space, but there's a lot of different asset classes. I think they have 8, 9, maybe even 10 different categories. When I look across the market, there's a lot of vendors that seem to focus on commercial real estate or large corporations. And a lot of the large corporations, it might be the office space that they're really focused on, right? Think of a big bank. They do have bank branches. They do have some data centers. They may be smaller. They do have a lot of offices. And usually the examples I hear when I actually talk to a vendor, it's like we're in the bank branches or we're in the offices. So there's just this kind of normal pull or push, I'm not sure, to go after certain asset classes and not others. Do you have any thoughts on, because I think your point is a valid one, right? There's a lot of other asset classes and a lot of space, and you can make a case, I could make a case, this asset class is actually really attractive for a number of reasons. Do you have a sense of why we haven't maybe had as much distribution of we're the energy management company focused on this asset class, not, this other more common or more well-known asset class?
Yeah, I've got a couple ideas. I won't say that I've got the answer here, right? And maybe you can get there, but certainly like in the multifamily space, right? It's been challenging because of the relationship between the building owner and the tenant, and the amount of actual control you can have, even if you know what's going on inside a tenant's unit, right, is relatively low. And so the value drivers there are kind of limited in the first place. Now we're seeing some opportunities for lower cost, systems to be spun up, and there's a few vendors that are working on different approaches for that, right? That do so in a low cost manner. But that's the challenge, right? Is if you're inherently limited on how much value you can squeeze out of the system because most of those costs are being borne by somebody else, then the system has to be low cost in the first place. You can't have a 7-figure implementation process if you're never going to get any juice out. And so I think that's the tension with multifamily. Is obviously it's the largest asset class. There's tons of buildings. It's not well automated today. I think it's a space that's ripe for automation. But how do you build the right business, and how do you really truly as a product manager, right? Like really understand what you're building for and not overbuild, because you're not gonna be able to overcharge here. The second one I'd call out, as I mentioned, is cold storage. I think that tends to be a little bit more bespoke, right? And I don't have great insights into why the legacy players haven't built really strong products there. But I think the challenge with that one is it's a much more limited set of customers. It's a much more limited set of sites. They're bigger sites. They're much bigger energy users. But certainly they're not well automated either. I don't know if you've got a take on that one.
Yeah, no, it's a good point. I have not, you think of refrigeration OEMs and HVAC OEMs. I mean, fundamentally, it's the same process, right? It's the refrigeration cycle. You're cooling things, you're moving heat from point A to point B or from one area to another area. But you actually do have slightly different OEMs. It's notable Trane and Carrier both own transport refrigeration businesses, Carrier Transicold and Thermo King. And so you see the trucks driving around, the refrigerated trucks. What you're talking about is different, right? Stationary. The companies playing there, one, you're right, it's very bespoke. I think a lot of it, even if you've ever been to a grocery store, you can tell I'm really into this industry, but you go to a grocery store, sometimes they're rebuilding the refrigeration closets. Once I was at a Costco and like a whole aisle, they were just completely, it was closed. My kids were young. I mean, they're still young, but they really like construction. We're watching. I was explaining to them, oh, look, they're building it. Like you're building it's very different than even taking, an air cooled chiller up to the roof and it's like 5 different parts. You put them all together. This is just, we're building everything from scratch. Obviously condensers are going to be actual physical condensers. You're not building the condenser on site. But my sense is because it's just so bespoke, you end up with this long channel of we're the local operator that builds refrigeration in Las Vegas. We'll just like throw out a city. And they might be buying the products from a couple of OEMs. And there's a couple of OEMs that are focused here. And then there's, the HVAC companies that are building some components here too. But you as the buyer might just be going to a local service provider, integrator, solution provider. You could use any of those terms. And they're probably not in a position to deliver a lot of technology because at the end of the day, they're pretty small. And a lot of their business is, knowledge, capability, integrate, building like physical assembly, and then setting and configuring things, but not deploying their own software. There are, interestingly, some roll-ups I've been seeing, more private equity-backed roll-ups of, we're actually operating refrigerated warehouses, or we're the service provider to the refrigerated warehouse. And I think that might lead to a little bit more of a digital layer, if you think of it that way, for them. But I don't have a good answer for that either. I just have some observations.
Yeah, I mean, the one other just insight that I'll add to the mix. I was talking with a cold storage provider who's not an EIP partner a week or two ago, and we were having this kind of conversation. And they're working with one of these companies that's trying to be an integrator, but a venture-backed integrator at scale, and create some kind of standard processes, and not just be bespoke every time. And the question I asked was, so you've now done 3 or 4 buildings, like how much easier is it getting? And doesn't seem to be much of a learning curve, across sites, which kind of reinforces your point that, a lot of this does seem like it's bespoke in that industry in particular. The third one I just call out quickly would be the data center world, right? Given the scale at which those facilities are just growing remarkably, and changing their own designs, changing their own layouts, and energy becoming so much more core to what they do and how they get access to power. We're tracking a few, kind of industrial control players in that space that are, both just optimizing energy management between different servers, but also at the site level and thinking about, integration back with the grid. And so that's probably the other space that I see a lot of opportunity in, but it's not the space for some generalist, SaaS founders to try to go after. You really need to understand a lot about, electrical engineering and data center power infrastructure.
Yeah, we should wrap in a second, but it was funny. I was listening to a podcast about data centers, and it was saying, with the way AI is going, AI will design the chips in the future. And my first thought was maybe they'll also design the cooling systems. Data centers, though, I agree. In the last kind of quick thought I have there's definitely been so much build out that the market shares, at least at the HVAC layer, are changing to some degree. And I think it was late last year, maybe mid last year, Carrier in their earnings, their quarterly earnings, I believe, it could have been end of year, but I think quarterly earnings, they said we're gaining a lot of share in data center or in chillers. If you look historically, the two biggest chiller companies are York, which is owned by JCI, and Trane. And I don't have exact market size numbers, but they are the two leaders. And then Carrier would be third, and they've typically not been quite at the same level, but they viewed it as, well, this data center needs so many chillers. You do a few of those, you're actually kind of punching up in terms of weight. And you could argue maybe that's going to follow through with the whole value chain of just digital building solutions in data centers. Now that there's so much building, we actually can gain a lot of square footage a lot quicker than normal because they want something. The operators want.
Yeah, the hypothesis I'd want to see validated there would be how much of the solution you build for data centers is applicable or can be translated to other sectors, right? And my instinct is that it's one of the harder ones to transfer, just given that literally commercial real estate might not be into data. Data centers are literally all about data, right? Energy, right? Like data centers, literally their whole business is turning electrons into information, and so the ways in which you build these systems, the types of things you can flex are just wildly different than a commercial building where you can't just push a button and have half the people leave.
Yeah, you could actually argue, just to build on that they're taking the electrons and it's I've read the same share of power to run the servers. There's also about this. It's 45% there, 45% for the cooling, and then 10% is just for everything else. So you're kind of turning the electrons into both, chilled water if it's, if they're using, chilled water systems, they probably are for now at least. Yeah, so it's really interesting. Well, Jake, I mean, we could go for hours, obviously. I think this was really fun, really good. Last thing, where can people find you? If they want to learn more, I assume LinkedIn, Twitter.
Yeah, LinkedIn's great. I'm locked out of my Twitter account at the moment and trying to get myself back in, but there's not a lot of folks at the desk to answer those phone calls. So we'll be back on soon enough there. EIP's also got a broader brand and platform, including a great Substack that our head of research, Andy Lubershine, runs called Steel for Fuel. And Shale Khan, who leads up our deep technology fund, the Frontier Fund, has a great podcast called Catalyst. And so those are great other resources if you want to know what EIP is up to. But find me on LinkedIn. I'd love to chat about any of this stuff. And thanks for having me on today, Joe. And looking forward to continuing the conversation offline.
Absolutely. No, thanks so much.